Hello, good morning to all. Welcome to today's Daily Dose of Market Insights. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. So before we start our Daily Dose of Market Insights, today will be the Wednesday, 13th of December. Yep, so before we start our Daily Dose of Market Insights, let's take a look at the disclaimer slides first. All right. Okay, so leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. And as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so yeah, okay, let me make sure my screen. Okay, so basically, let's ask kickstart what happened during the overnight session during Europe and US. So yesterday we have one key data release, which is the US CPI data for November, right ahead of today's FOMC meeting. Okay, so yesterday US data came in more or less within expectation. So what I could see over here is I want to highlight the core inflation rate. That means the rate which is excluding energy and food actually came in at 4% year on year, in line with what market is expecting at 4%. So that's actually close to about a 2-year low. So if you look at the core inflation rate trend, okay, it's probably at 2 years. So what we could see over here is that inflation pressure in US to be pretty much subdued. But however, if we dive into the various component of the CPI basket, the services side of the story still remains pretty much a bit of risk, of an elevated risk. Why? Because if I were to dissect it according to the various component, there's this services component. That means we're talking about excluding goods over here, is that they actually take up to 5.17%, 5.17% year on year from 5.06% in October. So there's actually a slight uptick in this, we call it services side component of the CPI basket. So with that slight uptick in the services component, that actually reduces the market expectation of this interest rate cut to be priced in March. So if you look at the current pricing by the CME Fed Watch 2 over here, let me take you all to the current pricing first for today. Just have a quick recap. So for today, for sure, what we are seeing over here is that markets are expecting almost stampede, no change, very, very minimal chance of a rate hike. So more or less, this interest rate cycle is the terminal rate will be at 5.25% at 5.5% on the Fed fund rate. That means, i.e., there will be very small chance of another interest rate hike coming into this cycle. That means we are now approaching having reached the terminal end of this interest rate hike cycle. That means the terminal Fed fund rate will be at 5.25% at 5.5%. The next thing about market got to ponder upon is when will be the first cut coming in and the quantum of the interest rate cut into 2024. So after yesterday's slight uptick in the services inflation, as seen on the CPI data that I flashed out here a while ago, the total probability throughout 2024 over here has been priced by the Fed, has been priced by the Federal Reserve Fed Funds Interest Rate Future, calculated by this CME Fed Fund Watch 2. So what I could see over here is that in March, right now, previously about a week ago, we see close to about 60% chance of the first cut to come in March. Okay, this probably now has dropped down to slightly to 49%, 45%. So it's still relatively higher. So the first cut coming in March is still kind of a live event, given that it's not close to a low of a 10 to 20% probability. It's still at high about 45%. The biggest one is in May and June next year at 74% and 93%. So overall, we could see that very slim chance of any interest rate hike coming into 2024. All the probability is actually less than 5% over here. So if you look at the whole table, the meeting probability over here, total, you could see in all, there could be a pencil in close to 4 to 5 interest rate cut into 2024. So that is still no change compared to about 2 weeks ago, despite the fact that services inflation has a slight uptick in November based on the CPI data I shared here. So what you could see over here is that how does it imply the market expectation? So market expectation from the stock market perspective, yes, US stock market continued to be very bullish yesterday, so continued to push higher. So the Nasdaq 100 and the Wall Street 30, as well as the Russell 2000 and the S&P all closed in positive territory yesterday. All right, plus 0.46% for the SPX, Nasdaq 100, the outperformer, plus 0.82%, Dow Jones Industrial Average, almost the same quantum as the S&P, plus 0.48%. Russell 2000 is the one that underperformed, with a slight minor loss of negative 0.13%. But all in all, if you look at the heat map of the S&P 500, is a broadening up of this performance across the various sector, not concentrating on the technology space or the mega caps, the mega 7 space. It start to spread out throughout the rest of the sector, like the banks, the consumer cyclicals, the industrial, and the one that is underperforming will be the energy for sure. Why? Because they track very closely with this ongoing softness in WTI crude oil prices, which is still pretty much prevalent as they're going to trade in their medium-term downtrend. Okay, now also bear in mind that what factor is supporting this ongoing bullish tone in the US stock market is also this 10-year US Treasury yield that continue to remain soft below the 20-day moving average, that is acting as a resistance at 4.33% over here. All right, so despite the fact that as long as it didn't surpass this 4.33%, potentially it could still kind of indirectly add further liquidity into the US stock market, given the fact that why? Because the US 10-year Treasury yield considered as a long-term benchmark of cost of funding. So if the long-term benchmark cost of funding continue to be constrained below 4.33%, that could act as another form of positive impetus for the US stock market ongoing bullish tone, at least in the short term, as we head into the FOMC meeting later on. All right, so later on I will share with you all what are the key levels to watch out for the benchmark US stock indices. So with that, for sure, let me touch on what are the key economic data to look out for today. Just a while ago, we have the Tankan large manufacturing index up from Japan. So this takes the form that this is actually large manufacturer sentiment in Japan continue to improve, take up to 12 versus the previous quarter. Is released on a quarterly basis. So it's this Q4. So previously Q3 it was at 9, and it also surpassed expectation at 10. All right, and also the non-manufacturing index, we talk about the services provider, for Q4 it came in at 30, surpassed previous quarter at 27, and as well as the expectation of 27. So what it means that over here is that business sentiment in Japan, as surveyed by the large manufacturer and large service provider, are actually continue to improve into Q4. That means, i.e., it means that that could actually be another encouraging sign for BOJ to actually push forward their interest rate normalization policy. And still recall that BOJ is the only developed nation, or in fact only the world central bank, that still has negative interest rate policy since 2016. Yeah, 2016, 2015. Okay. Okay, so that's close about a 10-year already. So with that bearing in mind over here is that there could be an increased expectation that BOJ will start to actually remove this short-term interest rate policy, at least in the first half of next year, and could come as early as January or April as well, penciled in by some market expectation. So with that, that could actually see a divergence of monetary policy between the Fed and between BOJ, that could actually add on to this ongoing short-term bearish trend on the dollar yen. That means, i.e., further continuation of the yen strength against the dollar. So that I will share with you all in the short-term technical outlook later. For today, for sure, the all-important data to watch out for will be the rest of the day will be the FOMC meeting later at 3 a.m. Singapore time. So for sure, no change. What's actually is pivotal for market participants will be the release of the economic projection. That's the dot plot. Why? Because like I expressed earlier, based on the CME Fed Watch 2, market is actually pricing in 4 interest rate cut for 2024. So isn't that a bit optimistic? Yes. Why? Because the previous economic dot plot projection, the Fed only penciled in 2 interest rate cut for 2024. That was released in September FOMC meeting. And given the fact that CPI data itself, yes, even though it's actually accelerated on the downside, but however, services inflation continue to actually tick upwards. And also last Friday, non-farm payroll data is not showing that the US job market is into a tail fall, where there's a heightened risk of a recessionary situation in the US. So that could actually hold back the optimism of the dot plot to be in line with market expectation with 4. Okay, so let's say if Fed were to actually maintain their dot plot projection to keep it at 2 over here, but however, during Fed Chair Powell remarks over here, he may sound a bit more data dependent. That means he could actually advocate a kind of a dovish pause instead. That means he could put in the face that potentially the Fed could actually look out for any signs of slowdown in labor market and they be ready to act. Okay, so that could actually also be sounded as a sign of a dovish pivot that could actually maintain this ongoing seasonal positive, we call it impact on the US stock market, calling for a potential Santa Claus rally as we head into the remaining 2 more weeks before 2023 ends. Okay, so with that pretty much sum up with the fundamental sharing that I share with you. Also, right now, let's us jump straight into the short-term technical outlook chart, starting with the major indices. Okay, so let's start with the US stock market first, the Nasdaq 100. All right, so let me expand my screen so that you guys could focus more on the screen instead. So Nasdaq 100 going to push up higher within our expectation, clear above 16,310, fast approaching the first resistance at 6,430 level yesterday. RSI, yes, is in overbought region on the hourly, but the hourly RSI is also shaping higher high, not showing any signs of a bullish exhaustion. That means, i.e., there's no bearish divergence. So potentially, given that it's at overbought level, it could start to do a bit of sideways movement ahead of the FOMC meeting outcome and the release of the dot plot and Powell press conference thereafter. So pullback potentially towards to the 6,300 level. So now this level now becomes a pullback support level to watch out for. For sure, yesterday's swing low level, right at the release of after the release of the CPI data, is at 6,180, slightly above this former range resistance, now turns into a pullback support at 16,160. So for sure, 16,160 will be my Titan key short-term pivotal support for today to maintain this short-term bullish outlook on the Nasdaq 100. Next resistance to watch out for will be at 16,590 after 16,430. However, if we start to see an hourly close below 16,160, then potentially we could see a swing down to retest the 20-day moving average, acting as a support at 16,100. So for sure, overall, the short and medium-term uptrend remains intact on the Nasdaq 100, except that during the intraday session, given today's potential volatile movement, given that it's a key risk event, a breakdown below 160 could induce a bit of we call it a stop loss that's been triggered, i.e., or a bit of panic to actually see a test at the 1600 figure level, which is confluencing with the upward sloping 20-day moving average that is still acting as a support, implying to us that the short-term uptrend still remains intact on the Nasdaq 100. Okay, very quickly, moving on next with the Dow Jones Industrial Average, which is the Wall Street 30 we call a platform. So yesterday it cleared past our first resistance at 36,000, pardon me, 555 level. Next resistance to watch out for will be a Fibo extension cluster at 36,890, also conversing with the upper limit of this ascending channel that is in place since the low of 10th of November. So overall, today's key support level to watch will be definitely the former range top now turns into a pullback support level, also confluencing with the lower limit of this ascending channel, or at 36,250 level. Okay, so as long as 36,250 level holds, potentially, yes, we may see a bit of slight pullback given that the RSI has been hit the overbought level. Pullback level to watch potentially will be at 36,480. So as long as the pullback managed to hold at 36,250, we will still maintain this short-term bullish outlook with the next resistance level to watch at 36,890. Like I said earlier on, given today there is a major risk event, that a break below 36,250 could induce a bit of fear into the market to expose the next support level at 35,900 / 35,650. Yes, even though this support level is, if 36,250 is being taken down, this support level is being met, but bear in mind that it's still holding above the 20-day moving average, indicating to us that the short-term uptrend remains intact of the Wall Street 30, despite that if the panicky scenario or the fearful scenario turns up later on with the break of the 36,250 pivotal short-term pivotal support for today. So overall, net, we are still maintaining that short-term bullish outlook on the US Wall Street 30 index. Okay, now German 30. So this will be a bit of outlier. Why? Because the technical configuration of the German 30 is not as rosy as the US Wall Street 30 and the Nasdaq 100. Why? Bearish divergence on the RSI hourly chart. RSI continued to shape a lower low yesterday. Okay, after that bearish divergence signal. So all in all, what it means that over here, potentially after 6 consecutive weeks of positive closes, it may start to shape a minor corrective pullback within its short and medium term uptrend that is still intact. Why? Because price action is still holding above the 20-day moving average. So bear in mind, like I said, this is a very short-term technical outlook for today. We know that prices don't go vertical up and vertical down. They oscillate within a downtrend. So what I want to portray to you over here is the German 30 now is at risk of shaping this minor corrective pullback scenario within a short-term and medium-term uptrend. That's the simplest way I could explain to you all. Why? Because short-term momentum is showing bullish exhaustion as depicted on your screen right now. I share with you all. Bearish divergence yesterday, higher low on the RSI, price going to move higher at the overbought region. Thereafter, going to shape lower low thereafter. So no change. 16,910 level, 16,910 key short-term pivotal resistance to maintain that minor corrective pullback scenario within a short-term and medium-term uptrend phases for the German 30. Breakdown below near-term support 16,735, exposes 16,590 potentially for today. However, if we start to see an hourly close above 16,930, then all these odds of this minor corrective pullback scenario will be evaluated to see the continuation of this bullish impulsive move within this short-term and medium-term uptrend phase towards this Fibonacci cluster at 17,100 next. So that's for the German 30. Another lackluster session so far for the Hong Kong 33 index. So Hong Kong 33 index still failure to break above the first resistance at 16,500 level, but managed to hold above this support level at 16,100 for now. So for now, perhaps we start to see a bit of sideways movement between 16,500 and 16,100 on the Hong Kong 33 index. So only a clearance above 16,500 potentially could add on to further impulses to kickstart a continuation of this minor counter trend rebound that took shape from the low of this Monday towards the next resistance level at 16,890, which confluence with this coming towards this downward sloping 20-day moving average as well. That is potentially could be acting as a resistance level in the coming day, at least for tomorrow, as we know that moving average, it moves every day. Okay, so overall sideways for now on the Hong Kong 33 between 16,500 and 16,100. Overall, if it breaks above 16,500, let me stress, it's just a minor counter trend rebound. There's still no clear signs to indicate to us that we are kicking start a medium-term bullish reversal scenario for the Hong Kong 33 index. Okay, so that's pretty much sum up for the outlook for the major indices. FX market. So let us start with the dollar first. Over here, so the euro dollar. Okay, euro dollar going to trade sideways, holding above the 1.07 short-term pivotal support that we highlighted yesterday. So all in all, this support level still remains as a pivotal level to maintain the potential short-term bullish outlook. It got to clear above 1.082 for sure, because that is the level that was tested yesterday again before it pulled back. That is the 200-day moving average as well. So a clearance above 1.082 level will actually give much more credence to this short-term bullish outlook on the euro dollar to at least test 1.09 intermediate resistance in the first step. So these are the key levels to watch out for as we head into the FOMC, all important FOMC meeting later tonight. Okay, however, a breakdown below 1.0 figure level, then that could actually see an extension of this minor corrective decline that is in place since 29th of November high towards the next support level at 1.063, which confluence with the minor medium-term ascending trend line that is in place since the low of 4th of October. Okay, so that's for the euro dollar. Now, what's next for the sterling dollar? So over here, the sterling dollar also going to turn sideways, but still hold above the 200-day moving average at 1.25 figure level mark. Okay, so for now, this level will be a key pivotal level to watch to maintain that short-term potential bullish outlook, but it got to break up above 1.2610 level. So without a break below above this level, price action may just toggle between these two range of 126.10 and 125 figure level. A break above 126.10 potentially sees the medium-term resistance of 29th of November and 4th of December at 27.30, 127.30. However, a breakdown below 125 figure level could see the continuation of this corrective decline towards the next support level at 124.30, where the 50-day upward sloping 50-day moving average should actually come close to this level as well in the next couple of days, which is at converging at 124.30. So still maintain that potential short-term bullish outlook on the sterling dollar, holding above 125 short-term pivotal support level with the upside trigger level at 126.10. Okay, now Asia Pacific currency against the dollar for sure will be the dollar yen. So over here, if you look at the dollar yen right now, okay, that's the dollar yen. Okay, let me open the dollar yen chart. I think it's been close. Okay, so over here, the dollar yen continue to actually trade below the pivotal resistance at 1670 that we highlighted earlier. So as long as 1670 short-term pivotal resistance holds, still maintain that short-term bearish outlook on the dollar yen. First resistance support to watch will be at 144.20. Only a breakdown below this level potentially expose the 200-day moving average, acting as a support zone at 14230/14160 in the first step. However, an hourly close above 14670 could see the extension of this minor corrective rebound that took shape on last Friday towards the medium-term resistance at 14740/14860, which confluence with the 50-day moving average, the downward sloping 50-day moving average, and as well as the congestion area of 28th of November and 1st of December. So still maintaining that short-term bearish outlook on the dollar yen as long as 14670 short-term pivotal resistance is not surpassed to the upside. Aussie dollar, so Aussie dollar faith is almost the same as the euro dollar and the sterling dollar. Trade sideways between 65.20 short-term pivotal support level and this upside figure level at 66.20. So as long as this 66.20 continue to hold, not surpassing the upside, the Aussie dollar could maintain to trade sideways. So for sure, the bullish momentum will only be revived if we see a clearance above 66.20 to expose the next resistance at 66.65/67 figure level. But however, if we start to see a breakdown below 65.20, then this short-term minor corrective pullback could extend to test the medium-term ascending channel support at 65.40. We also confidence with the upward sloping 50-day moving average at 65.40 as well. Okay, so that's the short-term outlook on the Aussie dollar, and that's wrap up for the FX market. Now for gold continue to remain weak. So I could see gold over here is an extension of this minor corrective decline that is in place from last Monday all-time high at 2,149, inching towards 1955 level. Okay, so very close. In fact, I'll give it a zone over here because approaching the 50-day moving average as well. Okay, so it will be a zone of 1965 slash 1955 level. Okay, 65 slash 55. Okay. Okay, so as long as this tighten key short-term pivotal resistance holds 1997 is very important. Why? Because yesterday, right after the CPI data release, it tested and didn't break up and shaped that bearish reaction. So, but however, it's approaching very close towards the potential end of this minor corrective decline. Bear in mind that this movement here is still in a medium-term uptrend for gold, still holding above the 200-day and the 50-day moving average. That's spot gold XAU/USD. And also, do not forget over here is that on the hourly RSI, we start to shape that impending bullish divergence as well. Okay, so this could be a residual push down within this minor corrective decline scenario. That means the tail end of this minor corrective decline scenario before the bullish force reassert itself to potentially continue the impulsive uplift within that medium-term uptrend. So 1997 short-term pivotal resistance to hold short for that potential residual push down. Let's stress the word residual push down towards 1965/55. So this zone here could be the inflection level or inflection zone to kickstart a new potential bullish uplift within this medium-term uptrend for gold that is still intact. Why? Because it's still holding above the 20-day and the 50-day moving average, and short-term momentum has started to show exhaustion sign on the downside by the flashing of this impending bullish divergence signal or condition at the oversold level as depicted by the hourly RSI. For sure, a clear breakout above 1997, then we will start to see a much more the end of this potential a minor corrective decline. First resistance to watch out for 2017/2038. So that's the outlook for gold. Very nasty move down for WTI crude oil price yesterday. So this is the daily chart of WTI crude oil price, West Texas Oil we call it our platform. So yesterday it recorded a negative 3.7% decline, but right now it's approaching this major support zone of 4th of May all the way up to 29th of June. And for those who understand chart pattern over here, what we could see over here is that the chart pattern itself is actually flashing out a potential descending bullish reversal configuration. Okay, at this point, okay, let me draw here. This is the potential descending wedge configuration, indicating to us that it could be coming very close to a bearish capitulation, where there could be a potential bullish reversal coming into the picture. But unless price break above this high over here, which was yesterday's swing high at 72 level, before we can start to see a breakout of this descending wedge bullish reversal configuration. So all in all, right, what we could see over here is that in the short term, okay, so this is the watch out for. This is the daily chart. So if I were to flip to the hourly chart from here, so for the hourly chart, oops, pardon me, okay, let me oops. Okay, let me see. Okay, here we go. Yep, so this will be the hourly chart. So okay, so this is the hourly chart. So the hourly chart, right, I'll be having a more neutrality stance between 70.50 and the major support level at 67.55/67 figure level. Okay, unless we have a clearance above 70.50, then we could see a potential retest at 72.40. So that could be the upper limit of that potential bullish descending wedge configuration that I highlighted to you earlier on the daily chart. So sideways for today for WTI crude oil 70.50, and the major support level at 67.55/67 figure level. So with that, that comes towards the end of today's daily dose of market insight. Slightly longer. Why? Because I need to highlight various risk factor, macro and technical, given that today's is a key important risk event, which is the FOMC meeting that corresponds with the latest dot plot release. So with that, have a great day ahead, and we shall speak again tomorrow. Thank you.